Today's webinar is on gathering client data. The first step in terms of making a financial plan for a client is that of establishing some sort of a client-planner relationship. Now the next step is that of gathering client data. Now when the client walks into the room of the financial planner, now he comes with certain kind of a mindset and saying that as soon as he walks in, he'll probably ask some questions and the planner will be ready with a particular financial plan. But unfortunately that does not happen, because the client needs to actually explain a lot about in terms of his background, his needs, his objectives, his hobbies, his interests, etc., etc. Whereas the planner as well also needs to get some information about the client, because without that information about the client, he is not in a situation to make that financial plan. However, getting this data is not as easy as it seems, because just imagine a situation if the financial planner actually just put a set of forms in front of the client and say that, okay, no, you fill up these forms. Many times there will be, first of all, there will be some sort of a resistance in terms of filling up certain forms, because they will seem very boring and routine and monotonous, and he may not like to do it. And secondly, many times perhaps even the client would not even know exactly what to fill up in those forms. So what will happen in those cases is that you need to have both a structured and an unstructured kind of a situation. So ideally what the financial planner to do is first have a sort of an interactive kind of session and inquire and get some idea in terms of what the client really needs, right? And this process, it is always better that for filling up these forms, etc., both the planner as well as the client actually go through these forms which need to be structured. Now typically what these forms will consist of, right? Now the first part of these forms will consist of some information about the client. Now that client will be in terms of name, age, his occupation, his address, what kind of a profession he is, whether it is a regular job or is it a consultancy, then something about the spouse whether she is working, not working, then perhaps some information about their children, their ages, right? If you have dependent parents, then some information about them. Then of course there will be something in terms of financial goals. For example, you may have that, okay, I need to buy a car in let's say 3 years, or I need to invest in a house, I need to provide for retirement planning, or if you try to establish an education fund for your children, then there will be something regarding education funding for your children and something of that sort. Then there may be something in terms of life insurance and how much coverage do I need. Then there may be something on tax planning, right? So the client will obviously have a multiplicity of goals. And the challenge for the planner is that he needs to encourage the client to possibly list out those objectives in a very clear priority. For example, you may say that, okay, first is okay, short term, medium term, long term. So short term, okay, you may have multiplicity of goals in the short term, but he has to tell the client that, look, you tell me which of the goals is most important to you, right? So the name of the goal, the type of the goal that is there, the particular time period in which he wants the goal to be achieved, and lastly, what is the financial implications of that goal. Now, for example, he said, let's do want to buy a car. Right? And when you want to buy a car, okay, I possibly says within maybe 2 years. And what kind of car and how much you would like to invest in a car. So probably the guy will say that I need to invest something like maybe 5 lakhs in the car. So you put the value of 5 lakhs there. Secondly, you could say that, okay, I need to provide for education for my children. So then possibly you'll ask that how old are your children? So how old are your children? So the guy will probably say that, okay, I may be the children are right now 5 years and 10 years. So what kind of education fund you want? Okay, I need it for higher education. And when do you need it? Okay, I would like typically the education fund to be such that by the time they reach the 18th year, they would have enough corpus that that can sustain them through your graduation and your post graduation. And if they want to go in for a technical course or they want to do a business management degree, then they have enough money that is it. So the next step obviously would be, okay, now that you have devised that, okay, by the time they reach 18, now what is the sum of money that you want? So in that case, the guy will obviously describe that, okay, perhaps over let's say a 6-year period, I possibly may need, let's say, in today's terms, something like 3 lakhs per year in order to, provide them through education. Now 3 lakhs in today's terms, so obviously if you look at the inflation component, then you need to put that into you have to adjust it in terms of inflation component, and then accordingly, right, put that down. Similarly, you could have something in terms of retirement. Similarly, you could have something in terms of providing for your aged parents for their medical needs, etc., etc. Right? Now, that is one thing. Now, you first need to implicit, you need to explain to your client the need to have a complete set of goals and the financial implications. Right? Then the next step is that you need to possibly also administer to him a risk tolerance test. Okay. Now, this is one of the very key requirements of, or one of the bases or the foundations of having a financial plan. Because until unless I do not know what is the risk tolerance level of the client, it is very difficult to actually devise a financial plan. Simply for the reason is that I would not know what kind of instruments that I need to invest in. For example, if the client is very risk averse, right, and would like to, is possibly prefers safety in this principle. In that case, I possibly cannot insure a portfolio of him of a larger proportion of equity. So I need to accordingly tailor his plan accordingly, and possibly some of his objectives may be watered down, or they may be spread out, or they may be reduced, or something of that sort. Because if the client is risk averse, then obviously the rate of return that he is going to get on his investments possibly cannot meet those kind of goals. However, if there is a client who has a higher risk, who is able to take more risk, then in that case you have more leeway. You can suggest to him a variety of other instruments. So in that case, the risk tolerance test is very important. Now, risk tolerance test is typically contains around 15 to 20 questions, and would have questions with regard to, for example, we have something about in terms of his age, in terms of how secure his income is, in terms of how much cash flow does he have in case he's out of a job. So how much amount of for his expenses. So how many months of financial expenses can he bear? Right. So that those are some kind of questions, and there are some questions in terms of his attitude, general attitude towards risk. And there are some questions which have financial implications. For example, you may ask him a question that the stock market goes down by 20%, and your investments have gone down by 20%. So, like, what kind of situation, what kind of reaction would you have? Would you actually go and invest more into the stock markets, or perhaps you would just let your holdings be, or you would take this as an opportunity to get out of the market really fast? So, depending on his response, right, you can actually classify the investor in some of the risk categories. Similarly, you may put him into a situation that you are gambling, right? So there are different probabilities. The expected value may be the same, but in terms of the probabilities of loss or gain, then accordingly the client may choose a particular option, and then on the basis of those options and on the basis of the scores that he gives, you can actually classify the investor as being either aggressive by nature, or balanced by nature, or conservative, or moderately aggressive, or moderately conservative. Normally, we use around 5 categories of risk tolerance. Right? Now, when you look at this information, it is very imperative that whenever you are administering a risk tolerance test, you need to educate the client that this information, number one, is confidential. 2, also explain to him the purpose of the test and what you intend to do about the test, and how important it is for him to do this seriously. And so that because it will have obviously long-term implications in terms of the kind of financial plan that he is going to get, right? Now, when you are gathering client data, it is also very important that the spouse is also called together. Why that is there? Because it is because when you're talking in terms of goals. Now, the husband may have a typical set of goals, the wife may have a typical set of goals, and they may not exactly match. So in that case, sometimes it's always better to call both of them together and explain to them and discuss, right? So that whatever you have is it is ensured that both of them are on the same wavelength, right? Now, some of the goals, as I said, could be in terms of insurance of property, medical insurance, emergency fund, increasing the net worth, right? Provide for education, travel, retirement, estate plan, etc., etc., etc. Okay. Now, When you look of insurance, then the need for insurance is basically in terms of loss of the client's future earning power and any expenses which are associated with the transfer of estate to survivors. In terms of investment, obviously in terms of increasing his net worth, when you say tax exposure, you try and devise particular and find out particular financial instruments by which he can reduce his tax exposure. Okay, now in terms of qualitative data, you also have something about his goals in terms of his interest and hobbies, and as well as other assumptions that he may have with regard to his financial plan. Okay. Now, once you have gathered the data, now this fact gathering session actually does not happen in one session, right? You will have one typical session, then the client will go back, then he may come and call you back, okay, if there are some clarifications, and you may have a further appointment, right? And then again there may be something more that may be discussed, right? So finally at a certain point of time, both the client and the planner at one level, right, and say that now the entire client, the data gathering session is over, and now is the time when you need to put it down into on paper. So at that point of time, it is important for the planner to make a complete synopsis of what has happened in the meetings and put it forward to the client and say that, look, this is what you have done, these are your goals, this is the implications of it, and this is the information that you have given to me. Now on the basis of this, right, can I proceed or not? So depending on what is given, and if there is any disagreement, of course that is ironed out, and then after that, then basically the client gives the planner the permission that, okay, now you can proceed and we can go on to this. Now once the information that the planner has, in that case, right, he will start looking at the plan and figuring out what needs to be done. Okay, it is not necessarily that sometimes whatever the client has said, it has to be followed in total, because if you are having a professional relationship with the client, it is sometimes important that even if the client is putting forward something which may not be in his best interest, then it is the responsibility of the planner to let him know. If there are some things that have been omitted by the client, right, and the planner feels that this is important, that this needs to be discussed with the client and say that, okay, you're missing out these things and you probably need to also look at these things. In that case, then you also would incorporate that at a later stage. Okay. Now, when you have all the information, that typically that information is basically in, let's say, 4 or 5 levels. Okay, so one is basic information with regard to his database of names, address, etc. One is with regard to his goal sheet. Then you have something like an income and expenditure statement, and then income and expenditure statement is basically on the basis of his monthly plan as well as his yearly. Then his cash flow with regard to where his cash comes, where his cash goes, if there are any premiums that he pays with regard to either insurance, etc., etc., right? Any other investments, any systematic investment plans, any regular savings plan, for example, his PPF, right? Does he have a contributory provident fund, for example, employee provident fund, and how much does he contribute, and what is the yearly addition, expected yearly addition? Then there may be some assumptions with regard to how does he expect his income to grow, how much does he expect his expenses to grow, then what is the possible rate of inflation, what date is he required to retire. For example, we did something on the education needs, and we said that the child needs to be, by the time he's 18, I need this much amount of corpus. Similarly, at the age of retirement, okay, so this is the age I need to retire, this is the amount of income that I need, and this is the period for which I need income after my retirement, right? So all this needs to be mapped out, right? And they will be obviously constraints as far as the client is concerned. Now the first constraint is obviously with regard to his liquidity, right? The client needs to have sufficient liquidity. You possibly cannot invest and not keep enough for liquidity. The client may not have sufficient resources. So for example, he may say, I need 50,000 rupees a month after retirement. Now if his income is not enough and he has too many goals to fulfill, then obviously in that reference, he possibly cannot ensure an income of 50,000 after retirement, especially after adjusting for inflation, right? Then you may also have some things in terms of special needs. For example, there may be clients which may be divorced, or maybe a single parent, or maybe a widower. You may have a client who may be terminally ill, or you may have clients who have children who are mentally challenged or physically handicapped. Now all these are special needs in terms of financial planning, simply because for each type of client, the disposition of assets obviously changes. For example, if you're having let's say a widow who's lost her husband and she's got children to bring up, so obviously she is not the kind of person who can actually afford a lot of risk, because there's already loss of one parent, and she possibly cannot have money in those assets which may be risky, and she may lose that amount of money in volatile instruments. So depending on those needs, and then you also have, for example, as I said, if you have terminal ill parents or physically, so the expenses related to dealing with those on a regular basis. So you need to incorporate those issues also in hand before you actually devise a particular financial plan. Right now, once you have done that, right now, once you have had these typical situations in terms of what is current income and all, now you obviously need to project. Now projections for each case, right? Now you need to do a complete, let's say, a cash flow planning. For example, to take an example of, let's say, retirement. Okay. Now you say that on retirement I need, let's say, 30,000 rupees in today's prices per month to meet my expenses, right? Now I plan to retire at, let's say, age 55, and I plan to, probably I need to have, I don't expect to die before I'm 80. So that means for 25 years after my retirement, right, I need to have, adjusted for inflation, amount of 30,000 rupees per month, right? Now obviously what needs to be done is 30,000 rupees per month. I need to find out the actual corpus that I need at the age of 55 to sustain me for another 25 years. Now first I'll find the corpus, then I will subtract what is the accumulated value of the retirement benefits that I have, right? I may also have to subtract any gratuity, any earned leave, etc., that I may have. I may also can subtract any other accumulated investment benefits that I may have, which can be used to finance my retirement, or if there is any value of house which I can easily sell off to fund off my retirement, that is something that I can do. If there is a shortfall, then I have to figure out what is the shortfall that is there, and see the time period that I have and the possible instruments and the rate of return that I am going to earn on them, to possibly figure out what is the kind of yearly investment that I need to do to fund up basically retirement. After doing all this, right, once I have figured out all this, so basically when the plan is actually made, right, so we are typically, let's say, assume that we are covering, okay, maybe retirement, education, tax planning, right? So there has to be a complete sheet by which I am saying that, okay, this is your possibly increase in income, this is your investment, right? This is the possible cash flow that you may have, right? Once you have the cash flow, these are the instruments that you need to invest. This is going to be the rate of return. On periodic intervals, this is the amount that you need to redeem to meet particular goals and stuff, right? So you need to have a tax strategy. That means by choosing the instruments, you have to ensure that the tax liability is as minimum as possible, right? So you possibly get a maximum tax gain also. Secondly, there has to be investment strategy in terms of, for example, I need to have a 12% rate of return, right? Now, a 12% rate of return, I can, possibly do it in only one financial instrument, or I may choose one instrument or one type of instrument which gives me, let's say, 8%, right? And the other which may give me, something like 16%, and depending on the proportion that I invest in them, I get a total average of 12% rate of return. So, spreading your risks, and even within a particular investment category, for example, mutual funds, it must not necessarily that I invest in a particular mutual fund. I may again, increase my exposure to, let's say 5 or 6 carefully selected mutual funds, so that I know exactly that if one suffers a loss, then the other may also, there is a possibility of gain on the others. Basically spreading your, risks, right? So you need to have a tax strategy, an investment strategy, insurance strategy also, right? Because, for example, if this guy is saying that, okay, I'm 25 or 35 years of age, I plan to retire at 55. What happens if there is an unfortunate death? So he needs to provide for his family for at least 25 years of his not living. So there are some methods by which you can compute your exact insurable income, for example, in terms of his capital protection approach, human life value approach, and other approaches which by you can calculate the total amount of insurance that you would need. So according to that, you need to figure out how much extra insurance you need and what is the premium that is required to be paid, and what kind of policy I should need. For example, it could be a term life, it could be a ULIP, it could be endowment, it could be a whole life, depending on my capacity to pay premium and the coverage that I am getting for the amount of premium that I am paying. Right. Finally, once this entire plan is done, right, the plan is shown to the client. The client looks at the plan. If there is something that needs to be changed, right, if he agrees with it, then there is a agreement that okay, now the plan must be put in operation. At the same time, the plan should also contain something with regard to who is going to take responsibility for fulfilling the plan, which means that either the client himself takes it on, or it is the planner who is going to take on the responsibility of implementing the plan. In that case, right, you need to select the particular investments and stuff. So that also needs to be operationalized. Then there will be also some requirements with regard to how the plan is going to be remodeled or rebalanced, or when is it going to be reviewed. Right? So at regular intervals of time, the plan needs to be reviewed. So there has to be a proper time frame by which you can say that this needs to be reviewed. There are also in terms of some management or performance management reports that also needs to be structured, which means that at regular intervals of time, the client should be given the adequate information that during this period that my plan has done this much, right? This is the rate of return that I have got, these are the shortfalls, and possibly if the market is changing, then a suggestion that okay, the market is changing, perhaps just to take advantage of the market, the client possibly can alter his investment mix, because no particular financial plan is watertight, right? You can, depending on the circumstances and the market, need to change the plan to take advantage of it. A particular reason for changing the plan is also basically on the personal circumstances of the client, because in the intervening period, let's say another 3-4 months, the client may have suffered some personal tragedy. Now in that case, then the entire basis on which the plan has been prepared needs to be again remodeled. So both in terms of what has happened in the market as well as in terms of personal circumstances of the client, both are situations wherein you need to remodel and review the plan, etc.